Hey there, everyone. Welcome to a special Friday all-mailbag edition of Chart This with Dave Keller. It's Friday, December 6th, and I am your host, Dave Keller, coming to you from a beautifully frosty cold Redmond, Washington. Appreciate you joining me every weekday after the close. On Fridays, we like to do a special all-mailbag edition. It's been really cool getting this show off the ground here over the last couple months. Seeing so many people ask great questions during the episodes. I rarely can get to all the questions that we ask. So I put everything into the mailbag. We get a lot through comments on YouTube and via email. And so we try to put them all in the mailbag. And then on a Friday like this, grab some questions out and spend a little more time. I'm usually rushed at the end of the live stream trying to get to a question or two. And this gives us a little more time and space to answer some really thoughtful questions some of you guys have asked. So let's get right to it. Question number one, Dave, with charts like CEG, that's Constellation Energy, better to buy in after retaking the 50-day moving average or wait until the push to new highs? Thanks for asking about the CEG. Here's my daily 2-year chart of Constellation Energy. We talked about this on a recent episode, particularly because of this price gap. And let me zoom in just a little bit so we can see that price gap in a little more detail. Right, so this was the gap higher in September. We then kind of traded around a little bit. We gapped lower. That was on Q3 earnings. And so then we sort of traded higher. And I think the comment that I probably made, this was on an episode last week, was that it was encouraging that we'd actually finally filled that gap, right? I tend to think of gaps as kind of support and resistance ranges. When I was learning technical analysis, I was taught support and resistance levels were super important to have precise levels and to focus on how the price actually hit that exact level. And I think that's a holdover from pre-decimalization days. A lot of those techniques were developed in the 70s, 80s, maybe even further back in the 50s and 60s when stocks were traded on eighths. And so it was a reasonable expectation that a price would hit like an exact level and then turn, because there were only 8 increments between every dollar. Now, of course, we're at sub-decimal trading. So I think those days are behind us. I think you have to think of any support and resistance levels having sort of a natural bit of wiggle room because of the natural volatility and current market structure. Having said that, when there's a gap on the chart, I don't tend to have real explicit rules about what gaps mean. Some people I know do and have had success with that. For me, I just sort of draw, I usually do this. I usually take the chart and draw a kind of rectangle, and I'll do it in some lighter color so we can see what we're doing. So I'll usually do this on charts that I'm following closely, just sort of take that gap and then just think of that as a range. And then, because a lot of times once there's a gap like that, it's all about how the price relates to that range. And when we're below, usually expect resistance within the range, and the same above, you'd expect support if the price comes back down into that range. So filling the gap is actually pretty encouraging, because before it can retest all-time highs, we actually have to actually fill the gap. Now, with Constellation Energy in particular, and your question was a longer question, I broke down just a little bit to fit it on the screen here, but we were basically saying, how conservative or how aggressive do you play a chart like this? And I would say for a chart like this, I kind of wait for a valid break out of that gap range as a sign that something is different, that things are improving. What's happened so far is CEG is sort of languishing right at the 50-day moving average. It's languishing right at the upper end of that gap. We actually broke above there last week in November, right around Thanksgiving, but then the next day, this is a bearish Harami pattern where we have a big up day, then a big down day, and a short-term week. So attempts to break above the 50-day and hold it, attempts to break out of that gap range and hold it have all failed. The RSI is stalling out still within kind of that bearish range, right? Try to get above 60. So on that day, it all of a sudden looks like, okay, this could be it. But I always talk about follow through, right? That next day, especially after a big move, it's like, what happens the next day? Do you see additional follow through, additional validation? We did not get that in this case. Stock actually came back within the range. So for me, this is still, a neutral kind of mentally, and I'm waiting for a breakout above the 50-day and above that upper end of the range. And only then do I think a retest of the previous high in October is a reasonable expectation. Before we can get to that point, we have to get above that first level. For me, it's still wait and see mode. So I tend to just set an alert looking for a close above that level, then monitor to see if there's follow through. And until then, I'm holding off on a chart like CEG. A great question, by the way. All right, on your newer Dow Theory chart, what does it mean when the two charts are not moving in the same direction? You were asking about this chart, which is on my Mindful Investor Live chart list. And as a friendly reminder, if you go to, what is that link? marketmisbehavior.com/charts. You can go to the live list of charts that I keep updated on the stock charts platform. I have what's called a shared chart list. So I control these in my login, and then any updates I make, you can see it. So if you bookmark that URL, you can always see latest versions of the charts. And then with my Market Misbehavior Premium members, we obviously use this list of charts and then do a lot of additional things as sort of the starting point of our conversation as we look at these charts and then go on to other things. But you're welcome to check them out. You were asking about this, and I think you sent the question, just talking about the most recent data. And this is a 2-year chart, so pretty long term. Let's zoom in a little bit. And I think what you're talking about are, periods like this, right? In the short term, we have a bit of a disagreement where the equal-weighted S&P is trending downwards. The equal-weighted NASDAQ 100 is trending upwards. So, what does that mean? So here's the thing. I would say what you have to remember with this is Dow Theory, and what we're basically doing here is modernizing Charles Dow's original work from the early 20th century, right around the turn of the century there. And what he wrote in his essays was basically looking at the Dow Industrials and the Dow Railroads and looking for a confirmation between the two. So his general assessment was when those indexes are both going up, the market's in a confirmed bullish trend. When those indexes are both going down, the market's in a confirmed downtrend. And when they're disagreeing, when one is going up and when one's breaking out, the other one is not, or when one's breaking down and the other one is not in a downtrend, that's a non-confirmation. That's a big warning signal. Having said that, what I'm seeing here is not quite long-term enough for me to say that would be a Charles Dow sort of, non-confirmation. And that's why the chart I usually look at is more like this, because I'm just trying to look for general trends. These are trends that, like this is the last non-confirmation that I think was valid. This took place over a 6-week period from mid-July to late August, where the equal-weighted S&P was breaking out and the equal-weighted NASDAQ was not confirming it. Right around August, that was a big warning sign in my book telling me, okay, we're, part of the market, big, important part of the market, large cap growth is not confirming the breakout that you're seeing in the S&P. Now, as you can see in September and then into October, that divergence was negated by the fact that the NASDAQ 100 started to break out. And that's really been the story, going into the election, but especially after the election, is the reassertion of leadership from the magnificent stocks, right? Magnificent 7 stocks, names like Apple and Meta and Tesla, right, breaking to new all-time highs. And that's what's really propelling our benchmarks to further upside. So I would say the move that I think you're asking about is a little too short term for the time frame that I tend to think of Dow Theory. Dow Theory is more of a longer structural trend. I think of it more in terms of weeks and months as opposed to hours and days. Having said that, big picture divergences often start as short-term divergences. They just persist. And so that is absolutely why I keep this chart in my main chart list and I review it, pretty much every day. It's just looking for, signs that we may start to get a divergence. And certainly between now and early 2025 going into January, if we do see that pattern that you're picking up persist, where you see the equal-weighted S&P trending downwards while the equal-weighted NASDAQ 100 trending upwards, that could be a big warning sign going into January. For now, I would say, based on the time frame I think you're asking about, a little too short-term for me to say that that's a cause for concern just yet. Hope that answers your question. And thanks for asking about the newer Dow Theory. I think it's a great way of, really considering multiple indexes, multiple looks at the market. Next question, what's your take on DocuSign, ticker DOCU? Heading into earnings, and I'm sorry you asked about this before they reported earnings. They reported earnings on Thursday of this week, and I didn't get to your question during the episode. I wish I would have, because the earnings today, the reaction to earnings on Thursday has been quite strong. Here on Friday, and we're recording this Friday morning Pacific time. Stocks up around 27, 28% after a solid earnings win. So the answer to your question is, basically what's the outlook going into earnings? And I would say quite strong, right? On the daily chart, we've had a consolidation phase, right? We had this sort of sideways period, and then we finally broke out. And I would say October was the key, right? October is when we finally break to a new 3-month high. I regularly scan for stocks and ETFs making new 3-month highs to try to capture this sort of move, right? Stocks just breaking out of an established base. We call that a big base breakout. A basing pattern is kind of a rectangle on the chart. So sort of look at this period here. This represents a period of consolidation, of equilibrium, right? The market's sort of telling you DocuSign's worth about $555 a share, and we're just kind of oscillating around that equilibrium point. But then look what happened in October. We actually start to break out, right? We actually sort of reassert ourselves to the upside. That means we're breaking out of that range, and that's a pretty bullish sign. The momentum's improving, the relative strength is improving. All of those things are pretty good. I'm not showing the volume on that previous chart, but here we can see the chicken money flow really starts to improve as we break out in October, telling you we're kind of in a period of accumulation. So, I would say all of those signs are pretty good. So the gap that we saw today after earnings this week is just sort of the latest, move in the direction of the overall trend. Also, something like DocuSign, I think looking at the weekly chart really helps put some of those moves into proper perspective, right? When you're looking at the daily chart, it's like, all right, boy, this feels like this has gone up a lot. But if you look at the weekly chart and think about the last couple of years, right? DocuSign on an adjusted basis was up here in the upper 200s, around $300 a share in 2021. 2022, it got absolutely crushed. 23 and most of 24 have basically been a big sideways pattern between 40 and like 60, 65 on the chart. And so that breakout in September and October was huge in terms of changing the character on the weekly chart. So I think this is one of those where looking at the weekly chart, looking at the daily chart going into earnings tells you that we're really in a position of strength. Now, that's no guarantee that the stock couldn't surprise to the downside and that everything is ruined. We obviously didn't get that. It was a good earnings beat, but I would say, the technical configuration, certainly pretty strong. And that would give me pretty good confidence in holding a name like that through earnings because the momentum is strong and because there's a lot of optimism going into that earnings release. If the earnings were bad and if the stock gap's lower, then maybe I unwind the position. I'm happy to have made money on the way up going into that release. But I would say overall, the configuration was pretty positive based on those things we talked about. The big base breakout, especially on the weekly chart, that's a really good way to put these recent moves into a little longer term perspective and recognize that this still could be much earlier days in DocuSign as opposed to the 1-year chart, which makes it look like it's gone vertical. Still has a lot more upside to go when you put it into proper historical reference. I really appreciate doing these mailbag episodes, and I'm so enjoying doing Chart This with Dave Keller every weekday after the close. Just a quick plug. If you are looking for a fun gift for yourself or for your loved ones going into the holiday season, check out my recommended reading list, marketmisbehavior.com/reading list. You can access the books that I often gift to others. These are the books that by far I've gifted to more people than ever. I would say when people ask me when they're just getting started with investing, what book should I read? I literally start with these couple books. The first one, I'd probably pick 3. William O'Neill's How to Make Money in Stocks is the one I recommend most often because that really talks about how to combine chart analysis and fundamental analysis, good companies with good charts. And I think he brilliantly lays out a very straightforward way to identify winning stocks before they've gained a ton. The second one is Kindleberger's Manias, Panics, and Crashes. This is a history lesson on previous bubbles and previous busts. Those patterns, I read that book for the first time 20 odd years ago. I've seen and weathered a number of manias and panics and crashes from that moment. And I often think back to lessons from those previous market cycles. Market history often rhymes. And I would say books like this are just show you how repeatable a lot of these things are. There will be another period of euphoria. There will be another period of desperation. Learn about what's happened before. The last one would be Edwin Lefebvre's Reminiscences of a Stock Operator. This is basically a profile, what's the word? A dramatization of the real life trader Jesse Livermore, who traded stocks in the 1920s, so the Roaring '20s, and went to bucket shops in New York, and basically talking about how he analyzed stocks and trading psychology, still relevant 100 years after, when when the setting is there. A lot of books on technical analysis, behavioral finance, but I'll highlight, if you have people that are not in the investing space, but you still want to give them thoughtful books on how to improve their lives, I would go down to the personal development section. Two that I will highlight for you that I think were transformational for me. Number one, Brené Brown is a fantastic author, and I think her books, The Gifts of Imperfection, were awesome. I'm a perfectionist, and when I had the opportunity to read a book like this that just reassured me that that was okay, and that we are imperfect, and that's actually a very good thing, and there are benefits to the fact that we don't have to be perfect all the time. And I think you will find a lot of things in your life that are challenging make a lot more sense after you read Brené Brown's book. The other one is Dale Carnegie's fantastic book, poorly titled How to Win Friends and Influence People, which has this sort of dark connotation to it. It's the best book I have ever read on communicating with other people in positive and uplifting ways, on making your life a story about lifting people up and engaging with others and learning from their experiences and sharing your own. It's a fantastic read. And so someone on your list that needs to improve their communication, you want a not so subtle way of pointing them in the right direction, maybe those could be helpful. So check those out if you're looking for some gift ideas. marketmisbehavior.com/reading list. I hope you find it helpful. All right, let's keep looking at some charts here. Next question, Dave. Microsoft appears range bound, and I think there may be bullish divergences. Chaikin money flow, while still below zero, is making higher lows. Is this a change of character? This is another one that I received during the week, and I didn't get to it. It's actually maybe a week or two ago, because you're asking about it back here when some of these indicators are starting to improve. But before Microsoft had the week that it's had here, the first week in December, Microsoft, along with the other Magnificent Seven stocks, generally speaking, have done quite well in sort of this reinitiation of leadership. So first thing I would say is I love how you have this chart set up, and this is a trick that others like Grayson Rose likes to do this. So I'm trying to think of who else. Boy, Greg Schnell, the late Greg Schnell, used to do this kind of chart, which is more of a vertical chart. One of my analysts, Darren Chabot, shout out to the team at Fidelity, he used to do this as well. He actually put a monitor in his office, and instead of having it the normal horizontal, he pivoted it 90 degrees, so we had a vertical monitor just so we could look at the entire chart on one monitor, which I thought was an awesome call. What you've done here is you have the price action and volume at the top, but then you can go down, and on a normal monitor, what that means is you can just get rid of the noise of price and just look at the indicators. And I think that's actually a really good way to think of things. You know, the moment we focus on price, a lot of times that can bias a little bit what we're seeing on the indicators. Here, you kind of get rid of the price and just look at these indicators. What are these telling you? All right, the accumulation distribution is sloping higher. The Chaikin money flow, which had not quite gone above zero, was sloping higher. The MACD was sloping higher. The RSI was trending higher. So all of those things were trending higher. So even if you don't see the price, it tells you momentum's improving, trend is improving, volume's improving. All those things are pretty good. Now, since you asked your question, I would say these indicators have, for the most part, gotten a lot more constructive. The Chaikin money flow, which you specifically mentioned in your question, has gone back above the zero line, and that is the sign of a stock that has been in a distribution phase and then entering into accumulation phase. It's kind of what we saw here right after Thanksgiving, and sure enough, it's led to a nice uptrend in price. The RSI, and you noted in the longer question that I didn't include on the screen here, you notice how the RSI had stalled out around 60, which is usually a sign that a stock is not in a bullish trend just yet. Now, it was holding 40, which tells me that this is more consolidation, right? So when a stock's in an uptrend, pullbacks tend to bottom out around 40. You can see that on the left part of the chart. In downtrends, the RSI will kind of stall out around 60 in a chart going down. When a chart goes sideways, the RSI will kind of be range bound between 40 and 60, right? It's like neither side is showing strong momentum. This is basically telling you an equilibrium, right? Buyers and sellers are in agreement. That's kind of what the chart has been done. Now we're actually seeing a breakout on stronger momentum, on stronger accumulation, on stronger trend. I would say the chart of Microsoft looking pretty good. Now that we're breaking above 440, the question for me going into next week is, do we hold that? So resistance often becomes support. I'm putting a horizontal line right about there to see if we can hold that breakout in the short term. But overall, the indicators that you asked about, I would say support further upside from there for some of the reasons that I described. Thanks for asking about that chart. And again, I love that vertical sort of way that you've lined up your chart. And, again, if you want to take a monitor and turn it vertical, it's a great way to just see it all. But I actually like being able to flip that up and get rid of the price and just look at the indicators. Grayson Rose, who I mentioned, used to do that with a chart showing relative strength. I actually might have that chart here somewhere. There was something that Gaddis Rose, his father, had originally turned me on. Yeah, it's like this isn't the exact chart I'm thinking about, but you have like price on one side, but then you really could just like focus on relative strength. And I love that idea of not thinking as much about the price, but just focusing on the relative strength trends, right? So things like that, I think, are brilliant ways of using the visual space that a chart analysis provides. Next question. When do you get interested in a chart like ROK? That's a Rockwell Automation. This is an industrial machinery name. I have my daily chart here. I mean, the challenge with Rockwell, right, is it's not a bad chart, right? It's not a horrible chart. If you look at the last year, you haven't lost a lot by owning Rockwell, right? And if you start the clock at the end of 2023 and look at where you're at today, it's not bad, right? I mean, it's not like you lost money. You did at times during the year, but if you still own that position, you're okay. But here's the problem, right? I mean, pretty much everything has been going up, or a lot of things have, right? I mean, most growth stocks are major benchmarks. Gold, add to the list of things that have been cryptocurrencies, like so many things have gone up. So the problem with owning Rockwell during this period is not the money you've lost, because you haven't lost a lot. If you still, you're probably right around flat for the year, but it's the opportunity cost of the stocks that you didn't own. You've tied up your capital in an underwhelming name, and you've prevented yourself from gaining by owning things that were actually doing well. This is why relative strength is so important. And that can help you when during this period, when you see the relative strength going down. That for me is a huge red flag on a current position. This is why for stocks that I do own and ETFs that I do own, I regularly review them and just focus on the relative strength line. And the question is, do I own things that are outperforming the benchmarks? And if not, boy, I'd much rather own those things that are outperforming the benchmarks. So I would say this is a great cautionary tale on holding things where the relative strength is consistently down, because even if you're not losing a ton on that position on an absolute basis, you're really getting hurt on a relative basis. And that just tells you there are other things that are doing much better, right? Your capital is best served elsewhere. Now, having said that, from a technical perspective, over the last couple months, I would say Rockwell has actually improved quite a bit. And the relative strength is actually waking up a little bit. It looks still pretty low just because it's coming after that big downtrend. But, if you look at like the last, 3 months, the relative strength is probably not as bad, because we're just starting to improve a little bit because the price is actually going up a little bit, right? Starting to improve. We're now making a pattern of higher highs and higher lows. I think that's all pretty good. I would say from a technical perspective, what would prevent me from looking at Rockwell as a decent opportunity is because of the relative strength, which has been so underwhelming for so long. And now that the price is going up, a lot of other things are going up already. And so I'm probably already wanting to be there. I would say from a short-term perspective, what's encouraging about this chart is this. We had the, let's see, just making a quick little line here. This is probably what I would describe as a pennant. That's a horrible color. I'm so sorry. There we go. This is called a pennant pattern. A pennant pattern is where you have a breakout, which we did here, broke above the 200-day moving average. That's good. Then we have this short-term consolidation of lower highs and higher lows. That pennant pattern, you wait for it to resolve. And if it resolves up, which we saw here a couple weeks ago, that's a nice buy signal. And that happened as we were breaking above the July peak. So I would say not only are you breaking above, breaking out of that pattern to the upside, you're also breaking above that resistance level, which also lines up with the March high. Like, this has been a pretty important pivot point for Rockwell for a while now. And we've broken above that resistance, and now we're holding it. So overall, I think this stock above like 290, 292 is a pretty good chart. And I wouldn't mind taking a position on a chart like that. The kicker for me, though, with this sort of name, particularly given what's happened in 2024, is making sure that the relative strength improves from here. And if not, then again, I'm better off looking at other charts in other sectors. Last question, and then we got to wrap it up. Dave, I tend to get caught up in short-term moves. How much emphasis should a medium-term investor place on daily market activity? And I took the liberty of summarizing your question. You asked a lot about, watching my show every day where I'm, recapping what happened in the market today, and just, and you tend to feel yourself getting drawn into short-term movements. I will tell you, I designed the entire Market Misbehavior Premium membership, which is like my premium offering that you should check out if you're interested at marketmisbehavior.com. Click on the little become a member link in the upper right. Check it out for sure. But what the whole reason why I set that up was basically to try to help individual investors and financial advisors focus on the proper time frame. And that is really what the essence of your question is getting to. I would say you are not alone in the fact that you often get caught up in the short-term movements. And I would say things like brokerage accounts and financial media, largely speaking, don't help you to avoid that. Your brokerage account, their goal is to get you drawn in to take action. And so they often will focus on short-term movements because that's something to talk about. Financial media, they're trying to make everything into a headline to try to get you to watch that their advertisers are happy, which means every little blip becomes a big deal and fonts are big and colors are dramatic to try to draw you in and encourage you to stay plugged in at all times. The reality is, if you want to be a thoughtful, or what I call a mindful investor, you really want to focus on, you want to understand the short term. And that's why I do chart this. It's part of my daily process. It's built around my daily reflection on what just happened today. What did I learn today, right? What happened? What's new? What's different? But the way that I use that is I really build my own process around what's called the weekly routine. I call it the weekly flight plan, which is what I share just for my premium members only. It's my weekly exercise to look back at the week that just happened. I do it over the weekend. Markets are closed, and I say, all right, what did I learn? And now what am I looking forward to? And every week I do that same process. The daily updates, right? The daily market recap, which is this show, is basically to incrementally add to what I learned over the weekend, right? All right, here's what I think is happening. And then during the week, it's like, how is this playing out relative to what I was seeing, right? Or am I surprised by something? Is something doing something that was unexpected? Was something not a great idea? And all of a sudden that's changing. And so I'm looking more for changes to what I did over the weekend. And I think that's how I would encourage you to think about it. Do kind of your most important, thoughtful, strategic thinking on a weekly basis. Do it over the weekend when the market's closed. You don't have to be drawn into anything and just focus on that. Then the daily market updates are just to sort of update you on how things are progressing relative to that plan that you've already sketched out. That's the way that you don't get drawn into the short term, and you use it to add to sort of your longer term or medium term thinking as you ask. And I would also say a lot of the tools that we show on the live stream. So for example, this is the market carpet heat map visualization that I look at every day. Remember, you can do multiple timeframes, right? So look at a 1 month change and think about what names and groups and sectors are doing what over the last month. This is where you start to see that, investors are rotating out of healthcare and they're rotating into things like consumer discretionary. You can see that on the heat map for the last month because you look at what's red and what's green, and you can sort of infer that this is a rotation that is happening. I would also say use performance charts, what I call performance charts, to think about performance after major turns. This is a chart of the Magnificent Seven stocks after that August market low, right? If you look at think of the daily chart of the S&P, they have that major low in August 7th-ish, I think. And then we've sort of rallied from that moment. That was after the July peak. So if you start the clock there, you can see the Magnificent 7 ETF, ticker MAGS, is up 34%. The Qs are up 21%. The S&P is up 17.5%. Equal weighted S&P up 14%. Gold, which has been one of the better trades in 2024, is lagging behind all of those. Still up about 10%, but nowhere near some of these other ones. Thinking about performance after key turning points and recognizing what themes are emerging. That's not something that's part of the daily flickering ticks of the market. This is more of a thoughtful, longer term perspective. So again, if you're interested in that, by the way, marketmisbehavior.com/premium. And if you do want to sign up for it, I'd encourage you to check it out. Use the code YouTube when you check out, and I'll give you a good deal for the first 12 months on any plan. But that is really what I do with that, is try to help people do what I just suggested to you. Not get drawn into short-term movements. Think about the longer term and recognizing that the short-term movements just help you understand how that long-term picture is evolving. I think that's it. That was a fun one. Thank you guys so much for some really interesting questions. Again, a show like this is possible because of questions you guys are asking through the course of a normal week. I would encourage you, and I appreciate so much you keeping that up, asking great questions as we do the show. We'll continue our market recap show after the close. We're doing it at 5 p.m. Eastern, 2 p.m. Pacific. I've gotten some good feedback on that new time, and it's working pretty well. So we'll continue that for now. And as always, I appreciate you, and I appreciate you supporting me and Market Misbehavior. For Market Misbehavior, I'm Dave Keller. Have a great weekend, and remember, it's always a good time to own good charts.